Welcome to The Secret Retirement, how to take control of your financial future. Today we're going to talk about the self-directed IRA. We're going to talk about what a self-directed IRA is. We're going to talk about investment ideas. We're going to go over some rules about self-directed IRAs, and then of course more ideas on how to take control of your future. Well, first, what is an IRA? An individual retirement account is an investment tool created by the U.S. government to supplement retirement income. IRAs are generally available to anyone who receives taxable earned income throughout the year. What is a self-directed IRA? A self-directed IRA is an individual retirement account that the owner is in control of. The owner gets to choose what the account invests in. For example, you could choose for your account to invest in real estate, businesses, or loans. What can a self-directed IRA invest in? Mutual funds, real estate, mortgage loans, businesses, leasing programs, just to name a few. And if you look to the right, it shows the average rate of return for those types of investments. Now, most of you have heard the Rule of 72. The Rule of 72 is a basic investment rule that estimates the amount of time it will take to double your money. You divide 72 by the percentage of interest on your investment. For example, if an investment is earning 5% interest, it will take over 14 years to double your money. You take 72, divide it by 5, which was the interest rate, and you get 14.4 years. So back to that previous table. Mutual funds. The average rate of return is 10%. It would take 7.2 years to double your money. Real estate, the average rate of return is 20%, which would take 3.6 years. Mortgage loans, 7 to 15%, which would take anywhere from 10 years to 4.8 years. Businesses, the average rate of return is 15%, which is 4.8 years to double your money. And of course leasing programs, which again the average rate of return is 15%, which would be 4.8 years to double your money. Let's look at a real estate example. Bob and Sarah each have a self-directed Roth IRA. Bob's account has $125,000. Sarah's account has $90,000. Now most of you are thinking to yourselves, oh, wait a minute. We don't have near that sort of balance in our accounts. But these are just examples. A person can invest $10,000. If you have an account with $10,000 in it, you can find investments. So back to Bob and Sarah. The total value of their accounts combined is $215,000. Well, Bob and Sarah have found a foreclosure in their neighborhood, which, you know, the way things are going right now, that's a pretty common thing. The foreclosure is listed for $189,000. Bob and Sarah know this is a good deal. Before the housing slump, the houses in the neighborhood were selling for $225,000. Their objective? Buy the house with their IRAs, fix it up, and flip the property. And flipping, by the way, is just another way of saying they want to fix it up and sell it, and do it quickly. They negotiate with the bank to buy the house for $169,000 because it needs some work. They purchase the property using their Roth IRAs. The Roth IRAs contract the $20,000 in repairs to be done. They then realize their objective was off a little bit. They decide now is not the time to sell. We all have heard the adage, buy low, sell high. They find a renter for the house who signs a 2-year lease and pays $1,200 per month. This gives their Roth IRAs returns of $28,800 for the next 2 years. Their Roth IRAs actually receive the rent. But wait, there's more. After 2 years, Bob and Sarah decide to sell the house. The real estate market has now come back stronger than it was. The house has appreciated in value, and it's now worth $240,000. They sell the house for $240,000. Upon the sale of the house, their Roth IRAs gain another $56,000. The total returns on this $189,000 investment is $84,000. Remember, they had rental income over those 2 years, plus when they sold the house, they made $56,000. The cash-on-cash returns is 22%. So using the rule of 72, if we take 72 divided by 22, that money's going to double in under 4 years. Is a deal like this easy to find? Or were Bob and Sarah just lucky? Well, I guess you have to ask yourself, what is luck? Laboring under correct knowledge. With the correct knowledge, these opportunities exist, and they exist everywhere. But wait, there's even more. Will Bob and Sarah have to pay taxes on the sale of this house? The answer is no. With a Roth IRA, all earnings are tax-free. In other words, when they take withdrawals from their Roth IRAs, those were started with after-tax dollars, which means they already paid taxes on the money they started the account with, so all earnings will never be taxed. Let's look at a leasing example. Terry has a friend that is starting a lawn service company. The friend needs equipment, and Terry has a self-directed IRA that she would like to use to invest in the friend's company. Terry uses her IRA to purchase 2 lawnmowers for $12,000. Terry then leases the lawnmowers to her friend for 2 years for $1,000 per month. This will generate returns of $24,000 for Terry's IRA. After 2 years, she sells the mowers for $3,000 each and adds another $6,000 to her IRA. What are Terry's cash-on-cash returns? She invested $12,000 and received $30,000 in 2 years, which gives her an $18,000 profit. That's a 75% cash-on-cash returns, and we will give that a cha-ching.